Profit is a basic and important item in the financial overview that has various use in various contexts. Profit is generally seen as a basis for taxation, a determinant of dividend payment policies, investment guideline and decision making, an element of prediction. According to Suharjono, profit is interpreted as an imbalance in the company effort to produce goods and service. This means that profit is the excess of income over costs. Profit coverage. There are two concepts of profit coverage, namely, the first is current operating concept, the second is all-inclusive concept. The first concept is current operating concept. According to this concept, income only includes items that are regular in nature, an element of income, and also expense that are recurring in nature and come from current operation. Irregular items are not included as component of profit, so they do not reflect the future earning powers of a business unit. This concept is relevant to management interest as a measure of efficiency, which is related to the utilization of all input and resource used in order to generate profit. All-inclusive concept. According to this concept, profit coverage includes all changes and increase in net asset during a certain period, except those resulting from investment by owner and distribution to owner. There are four types of all-inclusive concept. The first is item originating from operation that discontinued, means the activities of the business are stopped or sold. These things can be recognized by two factors. The first is profit or loss from segment activities from the measurement date to the termination date. The second is profit or loss from segment termination. Extraordinary item. Extraordinary item is an event or transaction that has a material effect and is expected to occur rarely and does not result from factors that are repetitive in the company's normal business activities. There are two conditions. The first is unusual, means that a transaction must have a high level of abnormality and is not related to the company's ongoing normal activities. The second is rarely occurs, means that the event or transaction is a type of transaction that is expected to occur rarely in the future. The third is accounting changes. Accounting changes can be grouped into three types. The first is changes in accounting principle. For example, changing the inventory valuation method from FIFO to average. The second is changes in accounting estimate. For example, is estimate economic life of fixed asset or estimated uncollectible receivable. The last is changes in reporting entity. For example, is change in certain subsidiaries or change in the consolidated amount. The last is various period adjustment. There are three types. The first is correction of error in the previous period financial statement. The second is adjustment originating from the realization of income tax benefit on pre-acquisition operating loss carry forward from the purchase of subsidiaries. The last is error in prior year income measurement must be reported as adjustment to retained earnings. Income recognition. Recognition is the official recording of a rupiah amount into the accounting system so that the amount is reflected in the financial statement. The principle of income recognition is applied to the main point. There are: the first is when the income has been realized, the second is when it has received or obtained. Correct income recognition involves three conditions. There are: the first is revenue is realized when a company exchanges goods and services to obtain cash. The second is income can be realized when the asset of company received from the exchange are ready to be exchanged into a certain amount of money. The last is income is generated or obtained when a company has completed what it has to do to make a profit, when the earning process is complete. There are four income transactions recognized in accordance with the above principle, namely the first, the company recognizes income from product sales on the date of the sale. The second is the company recognizes revenue from the completion of service, when the service has been performed and can be billed. The third is the company recognizes income from granting permission to the other parties to use company assets, such as interest, rent, and royalties. The last is the company recognizes income from the sale of asset other than product on the date of the sale. Earning quality. Profit quality is the amount that can be consumed in one period by keeping the company capabilities at the beginning and end of the period the same. Profit quality is a measure to match whether the profit generated is the same as what was previously planned. The quality of profit is higher if it approaches the initial plan or exceeds the target of initial plan. Can be divided as follows. The first is based on the time series nature of earning. The example of it: persistence, predictability, and variability. The second is earning quality is based on the earning cash accrual relationship, which can be measured by various measures. The third is earning quality can be based on the qualitative concept of the conceptual framework. And the last is earning quality based on the implementation decision. Current value accounting. CVA includes all systems for calculating present value or change in specific prices, including current cost accounting or replacement accounting and current exit price accounting or selling price accounting. CVA is related to the rise and fall of the value of certain assets, not the decline in current purchasing power. There are two main approaches to present value accounting. The first is replacement cost, which is widely used in monetary asset, namely assets valued at what has been sacrificed against what will replace it. The second is cost of selling, namely assessing asset at the sales price level minus additional cost of sales accounting, current value, current result in gain on ownership and loss when non-monetary assets are evaluated. Income statement. An income statement is a report containing information on a company movement, which is used to measure the success of the company's operation over a certain period of time. Usually, investors use income statement to determine profitability and investment value. The income statement presents information to help investor and creditor predict the amount of future cash flows. Elements of income statement there are revenue, expenses, gains, and losses. Form of presentation of profit and loss statement divided into two. The first is according to normal operating income. The second is according to all-inclusive income. According to normal operating income argues that only income that comes from normal activities is included in the income statement, while items originating from unusual activities are only included in the retained earning report. So the bottom line profit is normal profit. According to all-inclusive income argues that all income originating from normal activities and incidental activities are included in the income statement, and only the final result are reported in the retained earnings statement. This kind of income statement divided by two methods. There are single step and multiple step. In single step, there are three stages in preparing this report. They are details of all operational and non-operational income, details of all operational and non-operational expense. The last is the difference between all income and expense. A number or amount is found that show profit or loss. Meanwhile, in multiple step, there are four steps. The first is the detail of operational income. The second is the detail of operational expense. The third is the detail of non-operating income and expense. And the last is to find the balance of loss and net profit. Benefit of an income statement. There are some benefits of an income statement. The first is evaluating company performance. The second is provide a basis for predicting future performance. The third is help assess risk. The last is developing the company.